The Fed has handed a new challenge to global markets. No forward guidance, only data. So the big question now is, which report will trigger the next major move? Well, with US non-farm payrolls and business surveys, as well as geopolitical risks in play, it could be a volatile week for dollar yen, euro dollar, and gold. So let's have a look at what the technical signals suggest about the next move in those markets. Having a look first at dollar yen, well, the pair faced a dramatic sell-off, and that's because of the coordinated intervention by Japan and the US. It looks like both sides spent more than 60 billion to save the yen, squeezing the pair more than 5% towards May's lows near 155. But as we all know, intervention actions have only temporary effects. But perhaps this time could be different, especially from a technical perspective, because the price has dropped below its 200-day moving average. We can see that previous sharp declines were posed near the 200-day moving average in January, in February, as well as in May. This time we are below this line, and that increases the risk for more negative actions. Of course, both sides suggested, warn that they could intervene again, but probably this week the focus will be on the US non-farm payrolls report. Forecast suggests another muted increase of 83,000 versus 57,000 previously in July. With the unemployment rate likely rising up to 4.3% in July and average hourly earnings remaining steady at 3.5%. As regards interest rates, the Fed kept borrowing costs steady last week and provided no clue about its next action, as that is the strategy that Kevin Walsh is determined to apply. So upcoming economic releases will be quite important, could be more volatile, as investors may try to get policy signals from data instead of any comments from policymakers and from the central bank. So probably the next non-farm payrolls report and perhaps even the private ADP release could be also interesting to watch in terms of market actions. Now, from a technical perspective, we can see that both the RSI and the stochastic oscillator are in bearish territory, but they're also dipped in oversold region. So that suggests some stability in the coming sessions. Perhaps if we stay below the 157.80, 158.30 constraining zone, a former support region, and where the 23.6% Fibonacci retracement level of this uptrend that started in April is located, then if we stay below this region, more declines could happen. The 157.70, 155 zone, where the 38.2% Fibonacci level is located, could be tested first ahead of the 153.95 zone. Failure to hold here could trigger another sharp decline, probably towards the 50% Fibonacci and the 151.80, 152 zone. Now the upside, in the event that US jobs data are priced to the upside, in case optimism returns that the US labor market is still very resilient to absorb a potential rate hike probably in September, then that could lift the price above the 158.30 zone and probably towards the 159.50 territory. Then beyond that, I would next target the 160.80 zone, where the 50 and 20-day moving averages are heading. Now, looking at the euro dollar, unlike dollar yen, euro dollar faced a nice rebound. It broke above the 1.1475 level on the back of a weaker dollar, and actually it managed to reach this resistance trend line drawn from January near 1.1560. We see some weakness happening right now as the dollar remains stable, and it would be quite interesting to see if this increase over here proves more sustainable, if the price manages to break this resistance trend line and continue higher. Well, probably a break above 1.16 and 1.6030, where the 23.6% Fibonacci retracement level of this sharp uplift that started in January 2025 is located, could provide a stronger bullish signal and take us up towards May's 29th high of 1.1685. Now, if the dollar resumes strength, and that could keep the pair below this resistance trend line and signal another bearish wave, particularly if the price fails to hold above 1.15, then I would target the 50-day moving average near 1.4T75, where the price previously faced resistance. Below that, the 1.1420 could be another key number to watch before we return towards June's lows near 1.1323, specifically the 1.1350, 1.1365, where the 30.2% Fibonacci mark is placed, could act as key support. If not, then the bearish outlook will resume, likely squeezing the price towards the 1.1290 and 1.13 region. Well, in the absence of any important Eurozone data releases, probably dollar volatility could determine the next action in euro-dollar. Eurozone's retail sales are the only highlight in the week ahead out of the Eurozone. But obviously, any remarks from ECB policymakers could be quite important. Well, the central bank is now enjoying a summer break, but let's see whether any monetary policy signals could emerge during this month. And having a look now at gold, well, this is probably also waiting for the next move in the US dollar. Well, it has been quite stable despite the volatility, despite the confusion on the geopolitical front. President Trump canceled planned attacks against Iran. Today, he also the US administration also suggested that new talks could start with Iran during this week, and that added some pressure on oil prices. But gold failed to gain on those news. It's still quite neutral within this symmetrical triangle, waiting for the next direction, either above 4,135 or 4,200, or below the 4,039.50 level. So perhaps U.S. non-farm payrolls could create fresh volatility in this market. But from a technical perspective, we are not yet in the bullish territory. The RSI is still below 50, and the stochastic looks to be looking for a bearish cross, while the MACD remains stable with below its zero line. So it's still a neutral market. Of course, I would, given the negative process in the simple moving averages, trend signals remain discouraging, so failure to hold above 3,950 level could stretch this downtrend towards the 3,740 region and 3,800 number. Then below that, perhaps the 50% Fibonacci retracement level of the long uptrend that started in 2022 could come next into view near the 3,600 number. Now, in the event of a stronger U.S. Jobs data, the bearish scenario could hold. Alternatively, in the event of weaker jobs, in the event of a weaker non-farm payrolls report, if there is a negative surprise, which could actually question the potential of a September rate hike, gold could start a new bullish cycle, probably breaking above the 4,200 level beyond its 50-day moving average to retest the 4,340 zone, where the 100 and 200-day moving averages are located. Then above that, all the attention will turn to this tentative resistance trend line near 4,417. So gold could face volatility both from US data releases as well as from any surprising geopolitical developments. Keep a close eye on the upcoming releases and any and all US data outcomes, as the Fed, as the absence of forward guidance could create more volatility when data releases come out. So that's all from me. Thank you for watching. We'll be back this Thursday for more technical updates. So have a great trading and see you soon. Bye bye for now.